It's great to be with you today and tell you a little bit about my paper, Why Are REITs Currently So Expensive? I'm Stijn van Nieuwerburgh. I'm a professor in finance at the Columbia Business School. The starting point of this paper is the observation that prices or valuation ratios in real estate have been rising for at least 2 decades. You can see this by studying cap rates, which are the ratio of operating income, net operating income to real estate prices. So when cap rates compress, when they fall, valuation ratios in commercial real estate rise. And so you could see for all the different major property types here that starting in the year 2000, we've seen substantial cap rate compression, with cap rates going from about 8 to 10% in the early 2000s to ranges of sub 5% at the end of our sample in December 2020. Now these and at the same time, we see that interest rates have also been declining. I'm also plotting in blue here the 10-year US Treasury, which has also seen a secular decline. So it's not a surprise that a lot of people have equated the decline in interest rates to the rise in valuations in commercial real estate. Now cap rates really tell us 2 things. They tell us the difference between the expected return on real estate and the expected growth rate of cash flows, NOI growth on real estate. And so they're not a pure measure of the expected return. In order to get at a cleaner measure of the risk premium in commercial real estate, what practitioners often will look at is a cap rate spread, which subtracts from the cap rate the 10-year Treasury yield. But that too is not a clean measure of the expected return on real estate or of the risk premium on real estate. In fact, it's the difference between the risk premium, the term spread, which is the difference between the 10-year yield and the 3-month yield, and the expected growth rate on cash flow. So again, we have not achieved this, separation of expected growth and expected returns. The same picture of cap rate compression emerges when we look at public real estate markets, at the REIT market. The red line here plots the dividend to price ratio on the index of all REITs. It's a series of equity REITs from NYU. And what you can see is the same kind of cap rate compression starting in 2000 to 2020. That's the period I showed you before with the data from private transactions from Real Capital Analytics. Here I'm showing it from REITs for REITs. Now, the nice thing about REITs is that we can go back much further in time, starting in 1972, and we see kind of this longer term secular change. The other thing we see is that kind of in the period between 1975 and 2000, we have cap rates or dividend yields on REITs, being substantially higher than they are kind of in the period after 2000. At the end of the sample, we see kind of dividend yields at their lowest, at their historical low levels of about 3.3% in December 2020. And again, we observe this large gap between the dividend yield on REITs and the 10-year Treasury yield, which hits an all-time low in March of 2020. And so this leads me to my question that I want to answer in this paper. What drives commercial real estate valuations? We know it's an industry with booms and busts, with cyclical dynamics in prices and in valuation ratios. It's also an industry that has seen kind of secular declines in cap rates or in secular increases in valuation ratios. And a natural hypothesis to test here is whether this decline in cap rates simply follows the decline in long-term bond yields. I'm going to offer a risk factor model to study this question. And obviously this is an important question because investors need to know expected returns and risk on commercial real estate when they want to build a well-diversified portfolio, not only of real estate, but increasingly large institutional investors like sovereign wealth funds and pensions will be combining real estate allocations with allocations to stocks and bonds, and they want to be able to measure expected returns, variances, and covariances of real estate returns with stock and bond returns. So this presentation updates the analysis in a paper that I published last year in 2019 in Real Estate Economics. The data in that paper went until the middle of 2016. I have now updated the analysis until the end of 2020. So I've shown you the cap rate or the dividend yield on REITs so far. Now let me show you kind of the inverse of that ratio, the price dividend ratio in the red line in the left panel. And what this price dividend ratio plots is basically how much do you need to pay, how many years worth of dividends do you need to pay for a share of a representative REIT, right? And so, 2 things that immediately jump out from this picture are the cyclical fluctuations in these price dividend ratios. You see this very clearly in the great financial crisis when valuation ratios fall off a cliff and then promptly rebound coming out of the great financial crisis. You also see this sharp drop here in March 2020, which is the COVID crisis when the stock market sells off, and this very sharp rebound after March 2020. The REIT market ends the year 2020 with a price dividend ratio above 30. So REITs are basically very expensive right now. They are expensive relative to the type of valuations that we saw before the year 2000, when they were more in the 10 to 15 range. And this is in some sense not a new phenomenon. It's a phenomenon I pointed out in my paper with data going back to only 2016. You see this period coming out of the great financial crisis, we also had very high valuation ratios for REITs. Now, what's maybe surprising is that these very high valuation ratios, especially at the end of 2020, are coming at the same time that we're seeing very low cash flow growth realizations, right? So at the end of 2020, we're seeing NOI growth that's at -16, -17% year over year. We similarly, and so NOI growth is kind of this very cyclical variable with recessions and expansions. It doesn't look like there's this period where NOI growth, after 2000 is always higher than it was before 2000. So it doesn't seem that, either the secular changes in these valuation ratios in the left panel, nor the high valuation ratios at the end of the sample are naturally explained by looking at cash flow growth. And so this creates a bit of a puzzle. This sets up a bit of, a mystery. How do we, resolve this apparent disconnect between the current very high valuation ratios in the REIT market and the seemingly very weak fundamentals in commercial real estate? So to try to shed some light on this, I'm going to use a very standard framework in asset pricing, which is the Campbell-Shiller present value framework, which was one of the reasons that Bob Shiller won the Nobel Prize in economics. That framework basically says that the valuation ratio on any risky asset, the price dividend ratio, can be understood as essentially the sum of two terms, or the difference between two terms. On the one hand, you have expected cash flow growth, expected dividend growth in the next period, and in all the periods thereafter. These future periods get discounted, by some number that's smaller than one row, minus expected future returns. Okay, so what does that mean? That means that when we observe a high valuation ratio, it has to be the case that either the market expects future cash flow growth to be strong, or the market expects future returns to be low, to be weak, or some combination of the two. So what I do in this paper is I take the observed price dividend ratio, which is the red line here, and I combine it with a model for the expected return. So I'll be measuring the expected return based on a time series model, a factor model for REIT returns. And then based on the price dividend ratio, the left-hand side, and the second term of the right-hand side, I can back out the first term on the right-hand side. I can back out what the market expects for future cash flow growth, for future NOI growth on real estate. Okay, so let's do that. So the challenge here is to come up with a model for the expected return. So now let me tell you a little bit how I do that. So I'm going to use a factor model for REITs. Let me preface this by saying that there are really great REIT data available in the United States that date back all the way to 1972, as provided by NAREIT. Just by way of summary statistics, we see that REITs have had about 10.8% annual returns over that sample. So very similar to the broader stock market, substantially higher than returns on the bond market. These REIT returns have been quite volatile, more volatile than the broader stock market, but not a lot more, so that the Sharpe ratio, which is the excess return over a T-bill relative to the volatility, has been similar for REITs and stocks, okay, about 0.37, and similar also to the Sharpe ratio on bonds. REITs have been a little bit more negatively skewed than stocks, which means that they had more, negative returns, large negative returns, than they've had large positive returns. So my model for the expected return on REITs will be a simple factor model, where I basically will take the stance that REITs have some stock market exposure and some bond market exposure. Okay, that's my simplest model. It's a two-factor model with a stock market factor and a bond market factor that is written here in the second column. Okay, so when you estimate this two-factor model, you basically get a beta, a REIT beta for stocks and a REIT beta for bonds, which measure the exposure of REITs to the stock market and the exposure of REITs to the bond market. And what you see is that, you know, REITs have a stock market beta of about 0.67, which makes them into, you know, defensive stocks, like stocks like utilities, for example. They move less than 1-for-1 with the overall stock market. They also have a modest exposure to the bond market factor. Now, that model does a reasonable job describing the dynamics in REIT returns over time. It explains about 38% of the variation in REIT returns. We can do even better by recognizing that REITs are very similar to small and value stocks. Okay, so by adding two more factors, we graduate from a two-factor to a four-factor model. We now have the stock and the bond market factor, a small stock factor, and a value stock factor. And that model explains almost 53% of the variation of stock return. So it's a good model. It's a good description of you know, risk and return dynamics in the real estate market, in the REIT market. We also see that relative to this four-factor model, REITs do not have abnormal returns. They do not have alpha, right? So REITs are fairly valued according to this model. You know, you're getting just about the right compensation given the risk that you're taking. So what is the fair compensation for risk in the REIT market? Well, it's 11% per year. Okay, so that is the cost of equity capital in the REIT market, if you like. Now, this model so far assumes that the risk exposure of REITs to stocks and bonds is constant over time. Now, it turns out that that's not a good assumption because the risk is actually time varying. So in an effort to measure that time variation in risk, I'm going to allow these betas to be time varying. So what betas are is basically, you know, a product of volatilities and correlations. And so let's quickly look at the volatilities here. We see that equity REIT volatility, you know, measured by using 5-year rolling windows is kind of around 15-16% per year, but then jumps up in the great financial crisis before coming back down. The overall stock market also has a lot of time variation and volatility with these spikes in the 1990s and the early 2000s coming out of the great financial crisis, and then again more recently. And bond markets had more volatility in the 1980s and then lower volatility since. Correlations are also moving around substantially over time, but REITs at times moving very strongly with the overall stock market and at times moving very weakly with the overall stock market. And the same can be said for the correlation with bonds, where on average we have fairly weak correlation, but more recently we've had very strong correlation between equity REITs and bonds. So we can now, you know, combine that information on volatilities and correlations into a time varying beta estimate. And so here are these four betas, the betas of REITs with respect to stocks, bonds, small stocks, and value stocks, plotted over time. And again, the main message here is that there's a lot of time variation in these risk exposures. And in particular, that the stock market beta, the amount of stock market risk of REITs was kind of you know, around 0.5 and fairly stable over time until the great financial crisis, but then shoots up and kind of never came back all the way down to its pre-crisis levels. So we've had elevated stock market risk for REITs. Even more interesting is the bond market risk. We see on average, and you know, historically, there's been, you know, almost zero, close to zero interest rate risk in REITs, but then that interest rate risk has dramatically ramped up in the last 15 years. Size and value risk have been, you know, more constant over time. So what I want to do now is I want to combine these time varying betas that I just shown you with you know, my four-factor model. And I also want to allow for the equity risk premium, the expected excess return on stocks and the expected excess return of bonds, basically how much compensation investors are receiving for investing in stocks and bonds, for that to also be time varying. And I'm going to use risk premium estimates for stocks and bonds from a recent paper that I've written. So when you combine these time varying betas with these time varying risk premium estimates, you basically get a decomposition of the risk premium on REITs into these four components. Basically, how much of the REIT plus plus the risk-free rate, right? So if you think of the expected return, it's the risk-free rate plus these four risk premium. And so that's what I'm plotting here. I'm plotting these expected return here, and the expected return is the risk-free rate, which is the blue area, plus the risk premium for exposure to stock market risk, which is the red area, plus a risk premium for exposure to bond market risk, which is the yellow area, plus a risk premium for small stock risk, purple, and value stock risk, green. And so the upper envelope of this curve traces out the expected return on REITs, how much investors should fairly, should be compensated when all the pricing is fair, when there's no alpha associated with REITs. And so this is the line that on average was 11% per year, but you see it has a lot of time variation. In the 80s, risk premia, the cost of equity capital for REITs can be as high as 20%. At other times it's below 5% in the early 2000s. Now let's focus more recently, right? So remember that we started out by saying one of the explanations for the high valuation ratios in REITs, for the low cap rates in REITs, is that maybe risk premia have been very low. And coming out of the great financial crisis. And in fact, that has not been the case, right? So what we see here is that the expected return has been fairly constant, despite the large drop in interest rates. So, the Fed lowered interest rates all the way to zero. We were at the zero lower bound for about 7-8 years. But yet we didn't see a large decline in the expected return on REITs. And the reason is that this decline in interest rates was fully offset, or almost fully offset, by a rise in risk premia. The equity risk premium, the red area, became much larger. And then towards the end of our sample, the bond market risk premium, the interest rate risk exposure of REITs, became larger as well. That's the yellow area. And so at the end of the sample, the expected return on REITs, according to this model, is 8.6%. It's a little bit lower than average, but it's not so low so as to fully explain the high valuation ratios in REITs. So with this line, with this expected return model for REITs, and with the observed valuation ratio for REITs, we can now do the main exercise, which is to combine these two series and back out what the market expects future dividend growth of REITs to be. And this is the main picture in my paper. Okay, so what we're looking at here is an annual expected dividend growth on REITs. You could think of that as an expected NOI growth over the next 12 months. And historically, that number has been, fairly modest, around 2 or 3% per year, similar to the average realized NOI growth rate, but then with large fluctuations. So we see kind of a large correction here in the great financial crisis, and then a sharp rebound coming out of the crisis. Now, the key observation, both in my original paper and in the update that I'm providing you here today, is that at the end of the sample, expected NOI growth is very strong. It's somewhere between 10 and 15% per year. And it has been high for a while. Now, in the COVID crisis, we did see a correction, we did see a decline, but then we quickly saw valuation ratios prop back up, which the model interprets as a rise in expected cash flow growth. So at the end of our sample, what valuation ratios are telling us is that the market expects about 17% NOI growth over the next year, and as much as 45% cumulative excess NOI growth over the next several years. And that seems like a high number, especially in light of the current low cash flow growth realizations over the past year, which were negative 16.5%, right? And so this disconnect is kind of, one way of interpreting, or these high implied cash flow growth expectations is kind of the only way the model can explain the high valuation ratios in light of the fact that risk premia did not, radically fall. So to summarize, what the model says is that, REIT, or maybe by extension commercial real estate market prices, are very high, and they imply very high cash flow growth expectations, which suggests that they might be unreasonably optimistic, and that the REIT market might be due for a correction. This might be true, by the way, of the overall stock market and bond market as well, all of which are expensively valued right now. A second possibility is that I've just simply mismeasured risk in general, right? And so the secular decline in investor compensation for bearing risk in stock and bond markets may be much larger than what my model implies, and that too would increase commercial real estate valuations without the need for such high cash flow growth expectations. A third possibility is that there may be a disconnect between the REIT market and the broader commercial real estate market. And this could be, for example, because the REIT market is kind of contaminated by stock market noise coming from investors that are not real estate experts, but they're just kind of valuing stocks as if they were technology companies or energy firms. As a final point, let me apply this framework to one more interesting setting, namely the multifamily versus single family REIT setting, right? So I obtained REIT data for both of these sectors from NAREIT as well. Use the same factor model and the same factor risk premium estimates that I've shown you so far, and I back out expected cash flow growth from valuation ratios and expected return series for single family in blue on the left panel and multifamily on in red. And so interestingly, you see that cash flow growth expectations are tracking each other for single family and multifamily REITs very closely, and they fall together in March of 2020. But since then, coming out of the COVID crisis slowly, we see this much stronger cash flow growth expectations for single family than for multifamily REITs. We see a strong divergence, which I've plotted here on the right panel, which is the difference between single family and multifamily expected NOI growth. Okay, you see that kind of in the summer and in the fall of 2020, the market expects about 8 percentage points higher NOI growth on single family REITs than on multifamily REITs, which seems to suggest that the market values kind of suburban single family homes prospects much more favorably than the urban multifamily housing prospects. So to conclude, real estate valuations are highly cyclical. These valuations have rebounded very strongly since the great financial crisis. The COVID-19 pandemic has not lowered real estate valuations, at least not in the aggregate. Of course, it has done so for some sectors like hotels and retail. This public markets analysis in the US suggests that these high valuation ratios must be explained either by quite frothy cash flow growth expectations or by structurally lower risk premium on commercial real estate. Possibly, this is due to changing investor compositions, such as the increase of cross-border investors in the commercial real estate markets in the US. This is a hypothesis that I'm exploring in more depth in joint work with Ralph Coyen. And then finally, this application to single family and multifamily REITs suggests that the COVID-19 pandemic has changed the landscape for real estate valuations. For example, the premium to urban versus suburban real estate has reduced, and in some sense, and in some context, even reversed. And this is a topic that I'm exploring in much more detail in a recent paper with Gupta, Mittal, and Peters. So thank you very much, and I wish you a great rest of your conference.